Hello everyone, welcome back to my YouTube channel. My name is Rajat and this video today which I am preparing is a game changer for you to get a job into credit risk. I am going to tell you about the mitigation steps in the credit risk domain. Also, I am going to tell you the important aspects which you should tell in your next interview when somebody is asking you that what is your experience in the credit risk. Also, you are going to learn what are the steps each by one, and also you will be seeing what are the important component when you need to answer somebody on your next interview. So just be with me till the end of this video. It's going to be really beneficial for you if you are an aspiring credit risk or a financial analyst. So let's move forward. So as all of you can see, I have prepared this deck and I am going to share it with all of you free of cost. So you don't need to pay me. You can simply download it from my GitHub repository. I'll give the link in the description box. Okay. So now let me go on the top. So guys, all of you can see on your screen that this is the topic which we are going to touch upon. And I have mentioned specifically that this is a credit risk mitigation video and video for a job. Why? Because all these concepts which I'm going to explain to you today in this video, you can answer them in your next interview wherever you are giving in a credit risk company or in a financial institute. So let's start talking by them one by one. Okay. So primarily the question is always asked from a fresher perspective that, sir, what is the meaning of credit risk? So people usually ask me, Rajat, what is credit risk? The people who are starting with the domain, I'm talking about them, specifically the freshers who are just passed out from their colleges, whether they are from any normal college or IIT, whatever it is, they don't know credit risk because this is something specific to banking only. Okay. Now, what is the definition of credit risk from a perspective of somebody who don't even know about it? Okay. So there are two terms. One is credit, the second is risk. So what is credit? Fund lend out to a borrower. Who is a borrower? Borrower is me or you. All of us are the customer of the bank. We are the borrower. The borrower can be both retail or commercial borrower. It can be me as a single person, or it can be somebody who is having a commercial entity. Let's say you want to open a showroom of tractor. So you are going to basically take the loan for a commercial property. So that can be a commercial borrower, right? So in that case, the retail refers to household borrower and the commercial refers to the mainly firms. This is simple. Okay. Now what is risk? Risk is the event. I'll tell you in much more simple language. Okay. Risk is just a situation where the bank has any sort of loss can happen. That can be anything like reputation, money, or any other type, like maybe market risk, credit risk, operational risk, liquidity risk, all of them. Okay. So everything which can be a kind of a event so that the bank is losing something is known as a risk. Okay. Now if we combine both of them, so then we have a total here. What is the explanation of credit risk? Okay. To assess these sources from where scarcity in the cash flow of the bank would arise from the fund which are lent to a household or commercial borrower. So when the bank is giving the loan to the people, obviously there is a factor which is involved, right? That the loan will not come back, and bank don't want that. Simple, right? So to avoid that, bank has this whole chapter of credit risk, and this has been come to existence very long back. But I'll tell you the main reason why bank are following this all in 2025, because we are in 2025. All of you must know about 2008 financial crisis when there was a company called Lehman Brothers. They got bankrupted, and that was over $100 billion company. After that, all these regulators in the countries like in US, the federal government, Canada, OSFI, and in India, RBI, all of them are very worried because they wanted to keep that money in the bank. That bank should not be losing everything, right? Because the market won't be able to function. So that was the primary kind of a bullet point where all of these regulatory bodies thought that we should come with a solution where the bank should have minimum amount for the lender, and they should have more and more capital, so that bank is also able to make the profit, and also the money of the lenders or the borrowers, I would say, should be keeping safe. So that's the overall concept of credit risk here. Now, bank what is bank, right? So bank is a financial institute that run across the economy of the country. Very simple. Okay, then there is a concept of demand and supply. So bank always works on this concept of demand and supply. So what is demand in market? In a developing country there is a demand of loan. That's why people will be able to buy more houses there. That's why the corporate people will be able to do more business, right? And then supply is what? Supply is also the money which the bank is giving them. So there should be a equal demand and supply, both should be in sync. That's a very important concept. Okay, now how can the bank do this, right? So there are two sides of the funds. One is demand for funds, then second is supply for funds. Very easy. The bank objective of two is effectively channelize the fund from the supplier to the demander. Okay, what is the meaning of supplier and demander? Like, let's say I have a savings account in a bank. Now this savings account I kept on maintaining for 10 years. Now that money, do you think that bank is keeping that money in their pocket? No, bank is investing that money in market, or bank is giving that money as a loan to people. Your money will be safe, but that is the only money which bank is constantly rotating. You should know that. If you don't know that, you should know that. Okay, then make profiles in between. That's like making profile in between the demand and supply. So just understand from that perspective. Bank make profit through interest differently, or the interest value, which is the main profit bank is earning, is the most important thing for bank. As a banker, you should be always interested in making profit. That's it. That's the simple funda in the bank. Make the profit. Buy borrower from a low risk segment. Low risk segment are people who are like household mortgage. Why they are low risk? Because if a person is having a house, I as a bank will sell their house if they are not paying my money back. Simple. Okay, and lending to high risk segment like enterprises or producer. Why they are high risk? Let's say Infosys, I take a name. Infosys is taking a loan of 2 billion US dollar to start a new campus. Bank is giving them the loan basis on their current portfolio, but in future if the market crash, what will happen? They will not be able to pay the money. Okay, so that is something you should always know. Now in economy agent and fund flow, let's talk about this. Okay, so economy agent is what? Household, all the mortgages, house loan, all those things. Then bank is there, then the producer. Okay, it's pretty much simple. So let's say you deposit the 5,000 at the interest rate of 4%, then hold is 5,000, require 5,000. Simple. This is a simple mathematics here. If any question as of now, please put it in the comment section, guys. Now let's talk about the main topic, the mitigation techniques. Okay, so there are 8 steps which I'm going to talk about precisely in this video. So the step number 1 is considering the 5C of the credit risk. I hope you can see it. Just let me know if the font need to be, I think the font is pretty much fine, right? Okay, let me have a look, try to maximize if I can. Oops. Let me select all, go to the font, let me make it 28. Oh, 28 is too much. Let's make it 18, or let's try at 16. Seems to be good. Okay, I hope it's much clear now, right? Okay, guys, so let's talk about the 5C of credit risk. This is very important because whenever the bank is giving the loan, these 5C are always helping the bank. So the 5C of credit risk provide bank and lending institution, eventually bank only, a framework to identify the inheritance risk in the lending and mitigation credit risk. The 5C, you should remember the name, like the character of the client. Evaluate the counterparty or borrower credit history. Obviously, I'm going to the bank, my credit history should be checked. Then credit score of the customer, then payment behavior of the customer. Then second C is about capacity, that how much the capacity. So what is the assessment here? The assessment to determine the ability to repay the debt, whether I will be able to repay the debt or not, if I have the sufficient fund or a good job so that I will be able to make it up. Then third one is collateral. Evaluation of assets and collateral pledged by the borrower. Let's say I gave an example, right? If you're taking a home loan, so your home is a collateral. Your home will not be transferred to your name fully until you pay the loan, right? You should know that if you don't know that. Then conditions, analysis of the external and economic condition. Let's say there is a war in Ukraine, right? In Ukraine, Russia. So in Ukraine, if you're going to take a loan, it's not that easy because you don't know what is happening, right? So because the economy is fully disturbed, right? So this is about that factor. Now capital refers to the down payment of the investment by the borrower. So this is pretty much easy. Now these are the 5C. I gave an example already. Just remember character, number one, capacity of the client, then collateral, what the client can give to the bank, then the conditions of the person, and then capital. Conditions, I would like to add one more thing in condition. It's not only the condition of the person, it's the condition of the country, which I already told you. But the addition is it also depends on if there is any other condition. Like let's say I took the example of the war, but it's not only war, right? There can be COVID is also kind of a condition. In COVID, many people lost their jobs, so they were not able to pay the money. They don't have any money, right? Simple. That is a condition. So these are known as a 5C. I hope I'm clear till this point. Let's move forward. Then the second mitigation technique is the robust credit policies and procedures. So I'll read it out and to make you understand. Okay. Now prepare a credit policy with a well-defined criteria, outline the guidelines and procedure for making decision to safeguard the bank against the financial risk. Easy, right? This sets the foundation of effective credit risk management. The policy should clearly state the terms of the sale, the credit extension and collection process, that how the bank will collect the money in the end if the person is defaulting. Terms, what are the terms of that sale particular, which happened over maybe loan or any other portfolio, big credit cards and all that, right? Then credit extension, how much the credit will be extended. It's easy. Okay. As of now, if you have any doubt, please put it in the comment section. I will reply to it for the first thing for sure. Now the third point in the mitigation is robust underwriting standards. What is underwriting? When the loan is getting disbursed, before getting the loan sanction, there is a whole process which is happening, the whole documentation, right from the application. You go to the bank, you fill application, and then the loan is either approved or reject. So between all this, there is a person who's working, that is known as an underwriter. They do all the documentation, everything for you so that you can get the loan, and making sure without any wrong calculation. So that's why there is a job in the banking sector which is known as a what? Underwriters. Okay. They are not very much technical, but they are more functional domain wise. Okay. Now, what is this? Robust underwriting standards are stringent and well-defined guidelines for bank and financial institutes. They help ensure that only eligible and raw risk individual or entities, it can be entity, are approved for loan. Okay. Two, why they are doing that? Safeguard against excessive risk, minimize adverse selection, and then maximize the profitability. It also helps determine the amount of debt that should be issued by the bank, term of the loan, and interest rates. So as of now, we have covered the 3 points. And underwriter is a job also. You can search underwriter jobs in, let's say, Citibank, you will get the list. In Wells Fargo, HSBC, HDFC, Indian Bank, foreign banks whatsoever. So you'll get those jobs there. Okay. Now, according to the Federal Deposit Insurance Corporation, there are some things you should know. Okay. Now, while the FDIC doesn't set underwriting standards, it provides guidelines. What is guideline? In India, the guidelines are divided into the banks by RBI, because RBI is Indian, right? And what are the best practices here? Evaluate the applicant repayment willingness and capacity, review credit history, performance, and obligation, existing obligation. That means that the person should not have any other loan before taking our loan, because the person won't be able to pay 1 CR loan with just a salary of 10,000 rupees or 1 lakh rupees. So all those assessments should be done properly. Okay. Now assess the income, and it's a self-employed or businessman or an investment income, what kind of income he is having, considering the borrower overall credit relationship with the bank. That is also very important. Now, fourth point or fourth step, I would say, is adequate allowance for loan and lease losses, which we call A3L. Okay, A3L. So here is the A3L short form. The purpose of ALL originally referenced as a reserve for bad debts. What is bad debt? Let's say there is a person called Sam. He took a loan of 100k. He already paid 50k. Now, after 50k, he lost his job. Now, 50k is left plus the interest. That will be considered as a bad debt. Okay. So, this is, let me go up bit so that you can see it. Yeah, pretty much clear. Huh? So it is, this bad debt is to establish credit losses in the bank portfolio of loan and lease. Bank and financial institutes must maintain ALL to absorb estimated credit losses and ensure they have sufficient fund to cover potential losses, which is done by the market or any individuals. Okay, and then maintain adequate allowances. That means they should have the good capital reserve for the crisis situation. Okay, as per FDIC, bank must develop a program to regulate, review the adequate of the allowance. That is pretty much understandable. Okay, and then bank must understand the purpose of the allowance. They should have a clarity that why I am holding this much capital. Bank should know that this capital which they are holding is only for the crisis situation. They should not be using it for making profit in market, right? Identify bad loans quickly. That's why we have credit risk for the predictions, right? Implement a robust analytical process for establishing inheritance losses in loan and lease portfolios. Pretty much clear as of now. Any question, put it in the comment section. I will reply. Now, next step is credit risk monitoring process. This is one of the important part. Here you get the job. In credit risk monitoring, you can search for the jobs, credit risk monitoring jobs, and you will get so many, right? Now, what is that? Regular monitoring and assessment of change in the borrower risk profile. What is the borrower risk profile? Let's say there is a credit card portfolio in a bank, SBI. So in SBI, there are, let's say, 100 customer in Delhi who are using the credit card. Now, on out of 100, let's say 50 are bad, 50 are good. So the bank will make sure that the borrower risk profile should be updated. It should have a flag that these are 50 good customers, these are 50 bad customers. So overall, this as a profile, as a product like credit card is not a good profile because we have so many bad customers. Okay. Now, this is crucial for bank to identify, manage potential risk. It involves periodic credit assessment, like regularly, quarterly or monthly, something like that. Then account review, obviously that is also monthly process in bank. Timely follow up, overdue payment, that is done by the operations team. When the model validation, model monitoring team let them know, so they actually check it. Now, implementation efforts, collection strategy. So collection team need to make those strategy that how we are going to get back this money which we have lent and the people are not paying it. So this is what we are talking about. Now, these practices help bank response quickly to change the minimization of the losses. Okay, change the required attention include, what are the most important aspects here is change in credit score, bankruptcy filing, business structure, company closure, lawsuits, and change in management of the company. Okay, this is clear. All these things are done by the model monitoring team. There are separate model monitoring team other than the model development. In model monitoring, you get good money. All these companies, HSBC, Citi, Wells, JP Morgan, all of them hire people for that particular profile. Now, the sixth step is your stress testing. Regular stress tests help bank and financial institute identify potential source of credit risk and vulnerability in the loan and lease portfolio. Stress testing help bank analyze the ability to withstand with the recession, assess the impact of the adverse economic condition, let's say COVID, Okay, so how is the impact of COVID on the banks? All of that. Now identify the weakness of vulnerability. What is the meaning of vulnerability? Is those clients which are bit sensitive. Sensitive means not nature wise sensitive. Sensitive as in they are from some specific area, let's say, where the economy is not doing so good, or there is a war happening in that zone. All of those things are known as the sensitive situations or the weakness of the portfolio. Okay. Now ensure sufficient capital adequacy ratio. So CAR is a game changer. This is what bank need to maintain as a money in their pocket so that they can run the bank. Bank reports to the regulatory body of that particular country. Let's say in India, SBI will report the CAR to RBI. This is my capital adequacy ratio. Okay. Now maintain regulatory compliances, communicate risk clearly to all the stakeholder. What are the stakeholder? It's either model developers, it's model owners, it's model validation, it's model monitoring, or any other business executives, which are the executive level positions like directors, senior directors, managing directors in the bank. So that is stress test. Stress test is a very important portfolio. If you only learn stress test properly, you will get a job, because there are teams who are only working on stress testing. Stress testing itself is a portfolio, very big portfolio. Okay. Now, since obviously this video is a dedicated video for the mitigation, so I cannot cover the stress test, but if you want to understand it, there are videos, dedicated video on my channel. Okay, so explore them, I would say. Now the scenario based analysis, mitigation step number 7. Now this is pretty easy. Scenario based analysis help banks to do what? These things. Now analyze the impact of specific economic scenario, create possible future scenarios, establish potential credit losses, identify area requirement attention, develop proactive risk mitigation strategies. Easy, no challenges. Let's move forward on the final step. To build a skilled credit risk management team, bank must have a skilled credit risk management team with the diverse skill set, technical and functional. Okay, so statistical modeling people should be knowing in your team. That is very much into statistics. That's why people with MSc background also are hired, because they have done masters in statistics. Like risk assessment, data analysis, credit evaluation, all these teams should be there. So that's how all these functionality, Python, SAS, Power BI, SQL, R, Tableau, all these things are used heavily. Okay, and most importantly Excel, VBA, all these things are heavily used in the sector. Okay, so try to learn all of them. Many of them have a full playlist on my channel, luckily, so you can go there. Now they can hire experienced loan officers, which are the credit officers also, then loan underwriters. I told you that these are the job options all of you will have if you understand all this game, which I'm trying to explain to you guys. All these jobs are there in the market. You can crack the job, you can earn 20, 30, 50 lakhs also. Now additionally, banks should leverage digital learning solution to build a sustainable and measurable risk management workforce. Key element include identify relevant skill gaps, ensuring continuous workflow training like skilling, reskilling or upskilling of the team members depending on the need, and then assessing expertise capability of the various parameters. So these are the 8 steps which all the bank usually follow. Now let's precisely talk about the 5 special mitigation techniques. Those were the 8 steps. Now when the bank is having a mitigation technique, so bank and financial institute can use the following techniques, obviously. So let's talk about the technique number 1, diversify your portfolio. Never put all the money in a single portfolio. Okay, different asset classes, different industries, international markets, and then long term, short term investment. All these combinations should be the investment by the bank. So bank should always put their eggs in different buckets, so that if one bucket goes down or market is crashed, the second bucket should be going up, because always in market something goes down, something goes up. That's how it works. There are very rare scenario which are where everything is going down, like 2008 crisis when the whole banking sector was shaken up. Okay, maybe I'll talk sometime later about that. So now the second thing is obtain credit insurance. Take the insurance. Let's say in US you have AIG. So AIG is a very big insurance company. Bank usually take the insurance from them. Then collateral for security. Bank can request collateral from the borrower, which are moreover your houses, your showrooms, whatever you are taking. Then effective collection strategies, timely follow up, overdue payments, offering revised payment loans, maintaining open communication with the borrower. So there are dedicated relationship managers. They keep on following these things. They should. Now the fifth step is collaborate with the credit reporting agencies. Like what? Why should be that? Why we should do that? Okay, bank must work with the credit reporting agencies. Let's say you have CRISIL, then you have other rating agencies who rate, like CRISIL is one of the very famous one. Then assess the credit worthiness of potential borrower, make informed decision before extending loan or credit lines. So in India, CRISIL is very famous, and then there is Moody's, and in US, let's say you have Equifax. So bank should be in sync with all of those kind of agencies. Okay. Now, what is the conclusion here? Let's conclude this video. So, the robust credit risk management relies on the well-defined credit policies, easy to understand, comprehensive credit assessment, properly assessment of each portfolio by the team, diverse portfolios, use of assets and collateral for securing loans. Okay, assets are the most important thing which banks should sustain. They should have proper assets to make themselves always liquidate the fund. That is very important. Then continue credit monitoring. By implementing these practices, bank and financial institutes can reduce credit risk, prevent financial losses, ensure long-term secure in their lending operations. So they have a win-win situation. Now, this whole video was dedicated to the credit mitigation and the steps which we follow when we do the credit mitigation. And I have told you the 5 most common ways also which we use for the mitigation process. Now, one thing I want to add as a closure to this, I was talking about the 2008 crisis. What was that? Let me tell you in 1 minute. So, there was a bank, Lehman. They gave so much loan in the market that people buy so many houses. All those people who are not able to pay the money, they also got the loans. Okay, they also bought their houses. Then suddenly the market got simply crashed, and then people started selling their houses because they were having no money to pay back to the bank. Then everybody was literally selling their houses. Now there was so much of supply, but there was no demand. So all this came down to Lehman Brothers, and they were in deficit of more than 100 billion US dollar, which impacted so many other banks also. Lehman was one of the biggest, actually one of the very big investment bank. It was a competitor to Goldman Sachs. Can you imagine? That level of bank got failed, and this impacted the whole market. All other banks, like there was a bank called Bear Stearns that totally got sold out to JP Morgan, and then so many small investment companies which were there, they also totally got bankrupt, and the big investment company got sold out. Like let's say there was a company called Merrill Lynch which was purchased by a Bank of America. So in this, Greenlace was a company. One more thing I would tell. So there was a company, Greenlace. Like Greenlace was captured by Standard Charter. So all those things happen. So to avoid all that scenario, we need credit risk and market risk people in our bank. That's why we all have those jobs which we are doing in all these companies. On that note, I would like to take a leave from all of you. I hope you like this video. If you like my content, make sure you subscribe, you like, and you guys should share this video with your friends, your colleagues, so that my reach can spread more and I should get more motivated to make such videos. On that note, I would like to take a leave from all of you. All the best, everybody. And if you have any question, do put it in the comment section. I reply to each and every comment with proper my understanding. I read everything, then I draft a message for you. So thank you so much. All the best.